Before we begin, it's important to understand that the information provided in this video is for educational and informational purposes only. It does not constitute financial or legal advice. This content is not a substitute for professional advice from a qualified expert. So always seek the guidance of a professional with any questions you may have regarding a financial or legal matter. The email arrives at 2:37 a.m. You see it when you wake up. The subject line is simple: your invoice. It's the bill from the emergency room visit last month, the one you've been trying to forget. The number at the bottom makes your stomach sink. It's more than a month's rent. Your car is already making a weird noise, and your credit cards are hovering near their limits. Panic starts to set in, so you do what millions of Americans do in that moment. You pull out your phone, open a browser and type, "Fast Cash Loan." In less than a second, you're looking at a list of sleek, friendly-looking websites. Money in 24 hours. Bad credit okay. 5-minute application. Feels like a digital lifeline. You click, you fill out a few forms, and just like that, a message pops up. Congratulations! You're approved. A wave of relief washes over you. Problem solved. But what if that click wasn't a solution? What if you just opened a digital door and invited a predator into your financial life? A predator that operates in the shadows, using the internet to sidestep the very laws designed to protect you. Welcome to the Wild West of American finance. The world of online loans. It's a multi-billion-dollar industry that exists in a confusing, chaotic, and often dangerous legal gray area. And the scary part is, most people have no idea how it really works until it's far too late. You assume that a loan is a loan. You assume there are rules. You assume there's a financial sheriff watching over the town. But the reality is, the moment a loan moves from a brick-and-mortar bank in your town to a server in another state, or even another country, the rulebook gets thrown out the window. This is the central problem we are going to solve together. Over the course of this deep dive, we are going to pull back the curtain on the entire online lending industry. We're not just going to skim the surface. We're going to arm you with the critical knowledge you need to navigate this world safely. You will learn who the real regulators are, from the federal level with agencies like the Consumer Financial Protection Bureau, or CFPB, and the Federal Trade Commission, the FTC, all the way down to your state's Attorney General. You will understand the crucial difference between a state-chartered bank and a nationally chartered one, and why that tiny distinction can mean the difference between a fair loan and a debt trap. We will demystify the legal loopholes that lenders exploit every single day. We'll talk about shadowy concepts like tribal lending, where lenders affiliate with Native American tribes to claim sovereign immunity from state laws. We'll expose the rent-a-bank scheme, a controversial model where a non-bank lender partners with the real bank just to use their charter to charge sky-high interest rates that would otherwise be illegal. By the time we're done, you will be able to spot the red flags of a predatory online loan from a mile away. You'll understand your rights as a borrower, and more importantly, you will know exactly who to turn to when something goes wrong. This isn't just about learning facts. It's about gaining control in a system that is designed to feel confusing and overwhelming. So why is this so critically important right now? Because the world of lending has changed more in the last 15 years than it did in the previous 100. After the 2008 financial crisis, traditional banks tightened their lending standards dramatically. Suddenly, it was much harder for everyday people to get a small personal loan. At the exact same time, smartphone technology exploded. This created a perfect storm, a massive void in the market, and a brand new technology to fill it. Into that void stepped a new breed of company, the Fintech lender. Financial technology companies. They had no expensive branches to maintain. They used algorithms and big data to make instant lending decisions. They could reach anyone, anywhere, through an app. On the surface, it was a revolution in convenience and access. And for many it has been. Legitimate online lenders have provided much-needed credit to people overlooked by the big banks. But this rapid, unregulated growth also created the perfect cover for bad actors. Think about it. The laws that govern lending in the United States are a patchwork quilt. Most of the really important consumer protections, especially the ones that limit how much interest a lender can charge, known as usury laws, are passed at the state level. The maximum interest rate allowed in New York is completely different from the maximum rate in Texas or Utah. For 100 years, this system worked more or less. If you wanted a loan, you walked into a bank in your town. That bank had to follow your state's laws. Simple. But the internet doesn't have state lines. A lender can have its headquarters in a state with very weak consumer protection laws, like Delaware or South Dakota, and use the internet to beam loans directly into the phones of borrowers in states with very strong laws, like Colorado or North Carolina. So which state's law applies? The lender's state? Your state? Or is it some kind of federal law? This confusion is not an accident. It is the business model. Predatory lenders thrive in ambiguity. They set up complex corporate structures, route their operations through different states, and use confusing legal agreements precisely so that when you, the borrower, try to figure out if what's happening to you is legal, you get lost in a maze. It's a digital shell game. The lender might be incorporated in one state, use a partner bank from another, have its call center in a third, and be lending to you in a fourth. If they're charging you an interest rate of 300%, which is illegal in your state, who do you complain to? Your state's attorney general might say the lender isn't located there, so their hands are tied. You might go to a federal agency, but they might tell you that interest rate caps are a matter of state law. You're trapped in a jurisdictional nightmare, all while the interest keeps piling up. This is the system we're going to untangle. We'll look at the specific federal laws that do apply to all lenders, like the Truth in Lending Act, which requires clear disclosure of terms, and the Fair Debt Collection Practices Act, which sets rules for how they can try to collect a debt. But we'll also show you why these federal laws are often not enough, as they don't typically set a national cap on interest rates. That's the missing piece of the puzzle, the one that allows a lender in one part of the country to charge an interest rate that would land a lender in your hometown in jail. To truly understand how this is even possible, how this entire system was born, we have to go back in time. We have to look at a single, explosive legal idea that completely reshaped American banking. It's an idea born from a Supreme Court case that allowed a bank to do something revolutionary, to take the interest rate laws from its home state and export them to borrowers in every other state in the country, effectively ignoring the local laws of the borrower. This one decision cracked the foundation of state-based consumer protection and created the legal blueprint that the entire online lending industry, both the good and the bad, is built upon today. And understanding that single pivotal moment is the key to understanding everything that follows. That pivotal moment was a 1978 Supreme Court case called Marquette National Bank of Minneapolis versus First of Omaha Service Corporation. Now I know what you're thinking. A 45-year-old court case? How could that possibly be the secret key to understanding a loan you took out on your phone last week? But stick with me, because the story of this case isn't just about dusty law books. It's a story about a brilliant legal maneuver, a forgotten Civil War-era law, and a decision that single-handedly created the modern credit industry, and by extension, the entire regulatory landscape for online lending. Before 1978, the United States was a very different place when it came to borrowing money. The power to decide how much interest a lender could charge, what's known as a usury law, rested almost entirely with individual states. Each state had its own cap. For example, in Minnesota, the law might say you couldn't charge more than 12% interest on a certain type of loan. In Arkansas, it might be 10%. In New York, it could be something else entirely. This created a patchwork of 50 different sets of rules. For a local bank lending to local customers, this was fine. But for any bank with national ambitions, it was a logistical nightmare. Imagine a bank wanting to issue a credit card that could be used across the country. Which state's interest rate limit would they have to follow? The state where the bank was headquartered, or the state where the customer lived and used the card? For decades, the prevailing wisdom was that the customer's home state law applied. This meant a national credit card company would have to create and manage 50 different versions of its product, each complying with a different local interest rate cap. It was so complicated, so expensive, that it effectively prevented a truly national consumer credit market from ever taking off. Enter our main character, the First National Bank of Omaha, in Nebraska. In the 1970s, America was dealing with crippling inflation. The cost of everything was going up, and so was the cost for banks to borrow the money that they would then lend out to you and me. Many state interest rate caps, like Minnesota's 12%, were suddenly becoming unprofitable for banks. It could cost them more than 12% to acquire the funds, so lending at that rate meant they were losing money on every single customer. But Nebraska had done something very clever. In an effort to attract banking business, it had completely eliminated its interest rate caps. A bank in Nebraska could, in theory, charge whatever interest rate it wanted. The folks at First of Omaha saw a massive opportunity. They came up with a plan. They would base their entire credit card operation out of Nebraska and mail applications to customers in other states, including their neighbor, Minnesota. When a Minnesota resident signed up for their card, First of Omaha would charge them an interest rate based on Nebraska's laws, which had no limit, not Minnesota's restrictive 12% cap. It was a bold move. They were essentially claiming that their home state's law traveled with the credit card, overriding the local laws of the customer. As you can imagine, Minnesota was not happy about this. A local bank there, the Marquette National Bank of Minneapolis, saw what was happening and sued. Their argument was simple and seemed like common sense. If a business wants to operate in our state and lend money to our residents, it has to play by our rules. They argued that Minnesota's consumer protection laws were there for a reason, to protect its citizens from high-interest loans, and a bank from Nebraska couldn't just ignore them. The case was a classic states' rights battle. It slowly wound its way through the lower courts, with the entire financial industry watching. The future of consumer lending in America hung in the balance. Finally, the case landed at the highest court in the land, the United States Supreme Court. The 9 justices had to answer that one fundamental question. When a national bank in one state lends to a customer in another, whose interest rate law applies? The answer would change everything. The court, in a unanimous decision, didn't look at modern economic theory or the consumer protection arguments. Instead, they dusted off a surprisingly old piece of legislation, the National Bank Act of 1864. This was a law passed in the middle of the Civil War, designed to create a stable national banking system to help fund the Union War effort. Buried deep inside that 114-year-old law was a single crucial sentence. It stated that a national bank could charge interest at the rate allowed by the laws of the state where the bank is located. That was it. That was the magic phrase. The Supreme Court interpreted this to mean exactly what First of Omaha had hoped it meant. The location of the bank, not the location of the customer, determined the maximum interest rate. The bank was located in Nebraska, where it approved loans, processed payments, and mailed cards from. Therefore, Nebraska's law, which had no interest rate cap, was the only law that mattered. This legal principle became known as interest rate exportation. A bank could effectively export its home state's favorable interest rate laws to borrowers in every other state in the country. The impact was immediate and explosive. It was like a dam breaking. State usury laws, which had for a century been the primary tool for regulating consumer loan interest rates, were suddenly made irrelevant for any national bank. The decision triggered a frenzy, a corporate gold rush. Banks realized they no longer needed to be physically located in the big financial centers like New York or Chicago. They could put their credit card operations anywhere. So where did they go? They flocked to the states with the most favorable laws. South Dakota, for example, saw the opportunity and quickly passed a law inviting out-of-state banks to set up shop, and like Nebraska, eliminated its interest rate caps. Citibank, one of the largest banks in the country, famously moved its entire credit card operation from New York to Sioux Falls, South Dakota, almost overnight. Delaware quickly followed suit, and soon these 2 small states became the undisputed capitals of the American credit card industry, a status they still hold today. This single court decision is the reason why, when you get a credit card offer in the mail, the issuing bank is often based in a state like Delaware, South Dakota, or Utah, even if you live thousands of miles away in California or Florida. It created the very business model of a centralized, nationally focused lender. But more importantly for our story, it created the foundational legal blueprint for the rise of online lending 2 decades later. The internet would eventually remove the need for physical bank branches and mailed applications, but the core legal principle remained the same. The idea that a lender in a state with high interest rate friendly laws could lend to a borrower in a state with very strict laws, all while using its home state's rules, is the bedrock upon which the entire online lending industry was built. Every online personal loan, every payday loan, every fintech lending app that operates across state lines owes its existence to the precedent set in Marquette. It established that geography was no longer a barrier to lending, and that a company could strategically choose its home state to gain a regulatory advantage. This answered the big question for banks, but it also created a brand new, even more complicated question. The Marquette ruling specifically applied to nationally chartered banks. By the late 1990s and early 2000s, when the first online lenders started to appear, most of them weren't banks at all. They were tech companies, startups, and financial entrepreneurs. They didn't have national bank charters. So how could a non-bank tech company in, say, Utah, legally use the Marquette decision to offer a 36% interest loan to someone in New York, where the state's criminal usury cap is 25%? On the surface, it seemed impossible. They weren't a bank, so the National Bank Act shouldn't apply to them. And yet they did it. They found a loophole. A clever, controversial, and legally murky strategy that allowed them to partner with banks, effectively renting their charters to gain the same powerful advantage of interest rate exportation. This strategy would unlock billions of dollars in loans, but it would also ignite a decades-long legal war with state regulators that is still raging to this day. This strategy, which came to be known as the rent-a-bank or rent-a-charter model, is deceptively simple in its design, but mind-bendingly complex in its legal implications. Here's how it works. A non-bank, typically a fast-moving fintech company, wants to offer loans online to people all across the country. The problem, as we've discussed, is that pesky patchwork of state interest rate caps. If the fintech is based in a high-rate state like Utah, it can't just lend to someone in New York at 100% APR, because New York's criminal usury law caps rates at 25%. So the fintech forms a strategic partnership with a bank that holds a state or national charter, often a smaller, lesser-known bank based in a state with no interest rate caps, like Utah, Delaware, or South Dakota. The bank, using its federal preemption power, becomes the official originator of the loan. Its name is on the paperwork. It is, for a brief critical moment, the legal lender. Because of this, it can export its home state's favorable interest rate laws to the borrower, no matter where that borrower lives. But here's the twist. The fintech company does everything else. It markets the loans, it develops the underwriting algorithm, it processes the application, it services the loan, and, in most arrangements, it purchases the loan from the bank almost immediately after it's made, sometimes within a matter of days. The bank collects a fee for its participation, but the fintech assumes the vast majority of the economic risk and reward. To state regulators, this looked less like a partnership and more like a masquerade. They saw it as a deliberate scheme to circumvent state law. Their argument was powerful. The fintech company was the true lender, the one doing all the real work and taking all the real risk. The bank was just a pass-through, a legal shield rented for the sole purpose of evading consumer protection laws that had been on the books for decades. The entire industry was now hanging on a single explosive question. In these complex arrangements, who is the real lender? For years, the federal government seemed to side with the banks. The Office of the Comptroller of the Currency, or OCC, the primary regulator for national banks, issued rules suggesting that if a national bank is named as the lender on the loan agreement, then it is the lender for legal purposes. End of story. This provided a powerful tailwind for the rent-a-bank model, and the online lending industry exploded. Billions of dollars in loans were issued through these partnerships. It seemed like the states had lost the fight. Then, in 2015, a single court case threw a grenade into the entire system. It was called Madden v. Midland Funding. The case itself wasn't even about loan origination. It was about debt collection. A woman in New York, Saliha Madden, had an unpaid credit card balance with Bank of America, a national bank. The bank charged off the debt and sold it for pennies on the dollar to a debt collection company called Midland Funding. Midland then tried to collect the debt from Madden, including interest at a rate of 27%, a rate that was perfectly legal for Bank of America to charge, but which was higher than New York state usury cap. Madden sued, and what happened next sent a shockwave through the financial world. The Second Circuit Court of Appeals, a powerful federal court with jurisdiction over New York, Connecticut, and Vermont, made a stunning ruling. It decided that while the national bank, Bank of America, had the power to preempt state usury laws, that power did not transfer to Midland Funding when it bought the loan. The court reasoned that Midland was not a national bank, so it wasn't entitled to the same special protections. Therefore, Midland was subject to New York state interest rate caps. The industry panicked. The court's logic in Madden created a terrifying new reality. If a bank's preemption power didn't travel with the loan when it was sold, what did that mean for the entire rent-a-bank model? In that model, the fintech company buys the loan from the bank. According to the Madden decision, that fintech company might then be subject to the borrower's state usury laws, potentially making the entire loan illegal after the fact. The fallout was immediate. Online lenders and other financial players began pulling out of the 3 states in the Second Circuit. A lending desert started to form. It became harder for consumers and small businesses in New York, Connecticut, and Vermont to get access to certain types of online credit. The decision created a legal cloud of uncertainty so thick that it threatened the fundamental business model of a multi-billion-dollar industry. The financial world immediately began lobbying for what they called a Madden fix, a legislative or regulatory action that would reverse the court's decision and reaffirm that interest rates on loans are valid regardless of who owns the loan later on. They argued that for centuries, a core principle of commercial law has been valid when made, meaning if a loan is legal when it's first issued, it stays legal. The Madden decision, they claimed, upended this foundational idea and threatened to destabilize the secondary market for debt, which is a critical pillar of the entire American financial system. Years went by, and the uncertainty lingered. Then, in 2020, the OCC, under a new administration, stepped in. It finalized a rule designed to be a definitive Madden fix. The rule, known as the True Lender Rule, formally established that a bank is the true lender if, as of the date of origination, it is named as the lender in the loan agreement. It was a clear, bright-line test designed to end the debate. A few months later, another federal regulator, the FDIC, which supervises state-chartered banks, issued a similar rule. The industry breathed a collective sigh of relief. It seemed the war was finally over, and the rent-a-bank model was safe. But the relief was short-lived. The political wind shifted dramatically. In 2021, a new Congress and a new presidential administration took office, and they had a very different view. Using a powerful but rarely invoked tool called the Congressional Review Act, Congress voted to nullify the OCC's True Lender Rule. In a stunning reversal, the federal government's official position was wiped off the books. It was a massive victory for state regulators and consumer advocates who had fought the rule tooth and nail. This left the industry in a state of pure chaos. The OCC's rule was gone, but the FDIC's similar rule for state-chartered banks remained. The Madden decision was still the law in the Second Circuit. Other courts around the country had issued conflicting opinions. There was no longer a single clear answer to the question of who the true lender is. The law was different depending on where you lived, which court was hearing your case, and whether the partner bank was nationally or state-chartered. The decades-long legal war wasn't over. It had just entered its most confusing and unpredictable phase. Lenders and fintechs were left to navigate a treacherous legal minefield, while state regulators, emboldened by their victory in Congress, ramped up their enforcement actions against these partnerships. The stalemate was complete, a tug-of-war between state authority and federal precedent, with billions of dollars in commerce and the financial futures of millions of American borrowers hanging in the balance. But as the states and federal bank regulators battled to a standstill, two other, even more powerful forces were quietly preparing to enter the fray. One was a brand new federal agency, born from the ashes of the 2008 financial crisis, with a singular, powerful mandate to protect consumers. The other was a private force that controlled the very plumbing of the financial system, the payment networks that decide who gets to use their rails, and under what conditions. Their entry would change the rules of the game entirely. These two forces, one public, one private, were about to collide in a battle for the soul of online finance. But first, the government had to figure out how to fight a war on a battlefield it didn't understand. The internet wasn't like a street corner in Cleveland or a strip mall in Houston. There were no storefronts to inspect, no paper records to seize. There were just servers, often located in jurisdictions far beyond the reach of a state attorney general, on sovereign tribal lands, or in offshore havens like the West Indies. A lender could be incorporated in Belize, have its servers in Costa Rica, and use a bank in Malta to lend to a family in Nebraska, a state where payday loans were heavily restricted. How could Nebraska's laws possibly stop that? This was the challenge facing the newly created Consumer Financial Protection Bureau, or CFPB. Forged in the fire of the 2008 financial crisis, the CFPB was designed to be the single most powerful consumer watchdog in American history. And it arrived with a mandate to bring order to the chaos. At first, the Bureau cut its teeth on the low-hanging fruit, bringing massive enforcement actions against the big brick-and-mortar lenders who had been skirting the rules for years. They levied hundreds of millions of dollars in fines and forced companies to return money to wronged consumers. But they quickly realized that the real frontier, the truly lawless territory, was online. The stories they uncovered were harrowing. Lenders who would take a borrower's online bank account information for a single $300 loan, and then proceed to make unauthorized withdrawals for months, sometimes stealing thousands of dollars in bogus fees and renewal charges. They saw lenders who sold a borrower's personal data, their social security number, their bank account details, to other companies, who would then also start trying to withdraw money from the same account. The CFPB saw collection tactics that were brazenly illegal. Agents posing as FBI officers, threatening borrowers with arrest, calling their employers, their families, their neighbors, revealing the debt to anyone who would listen. The CFPB played whack-a-mole. They'd investigate a company, spend months building a case, and finally bring a massive lawsuit to shut it down. They would win, get a court order, and freeze the company's assets. But it was never enough. The people behind these operations were ghosts. They would simply abandon the old company name, stand up a new website with a slightly different name, and be back in business the next day, using the same lists of vulnerable borrowers. The government was trying to stamp out a wildfire one spark at a time. It was a losing strategy. And then, a realization began to dawn within the halls of Washington. The problem wasn't the websites. The problem wasn't the phantom call centers. The problem was the plumbing. For an online lender to exist, it needs two things. It needs a way to push money into a borrower's bank account, and crucially, it needs a way to pull money out. The entire business model depended on the ability to automatically debit a borrower's account on their payday. Without that, the whole house of cards would collapse. This automated debiting process runs on a system most people have heard of but few understand: the Automated Clearinghouse, or ACH network. It's the quiet, invisible workhorse of the American financial system. It's how you get your direct deposit from your employer. It's how you pay your electric bill online. It's a network run by a consortium of major banks that allows for the electronic transfer of funds between bank accounts. And it was the lifeblood of the online lending industry, both the legitimate operators and the predatory ones. Regulators realized that if you can't stop the thousands of lenders, maybe you can stop the handful of banks that give them access to this network. If you could just turn off their access to the ACH system, you could effectively put them out of business overnight. You wouldn't need to chase them across the globe. You could just unplug them. This idea gave birth to one of the most effective and most controversial regulatory initiatives in modern history. It didn't have a public announcement or a press conference. It started quietly, inside the Department of Justice in 2013. It would later be given a name by its critics: Operation Choke Point. The strategy was devastatingly simple. The DOJ, along with federal bank regulators like the FDIC, didn't go after the payday lenders directly. Instead, they went to the banks that held their accounts and processed their transactions. The conversation would go something like this. A regulator would sit down with a bank's compliance officer and point to a list of their customers. "We've noticed," the regulator might say, "that you're processing a high volume of payments for online lending companies. We consider this a high-risk activity. These lenders generate an enormous number of consumer complaints and chargebacks. They pose a significant reputational risk to your institution. And if any of these lenders are found to be making illegal loans, your bank could be seen as facilitating that illegal activity. We're going to have to subject your bank to a much higher level of scrutiny." No one ever said, "You must close these accounts." They didn't have to. The message was crystal clear. The threat of endless audits, potential enforcement actions for money laundering violations, and the public shame of being associated with predatory lending was more than enough. Banks are, by their nature, risk-averse. And overnight, they began to panic. They started terminating banking relationships not just with payday lenders, but with entire categories of businesses that regulators had flagged as high risk. The effect was swift and brutal. Online lenders who had been operating for years suddenly received letters from their banks. "Your accounts will be closed in 30 days. They were cut off from the ACH network. They had no way to issue new loans and, more importantly, no way to collect on existing ones. Legitimate operators and illegal scammers were swept up in the same dragnet. From the government's perspective, it was a stunning success. They had found the choke point. They had finally figured out how to starve the beast. But the story quickly grew complicated. The list of high-risk industries was broad. It included coin dealers, firearms and ammunition sellers, tobacco companies, dating services, and other perfectly legal businesses that the government simply seemed to find distasteful. These businesses also started losing their bank accounts. They hadn't broken any laws. They hadn't done anything wrong. They were being shut out of the financial system simply because of the industry they were in. The backlash was furious. Critics from across the political spectrum decried Operation Choke Point as a gross abuse of government power. They argued that federal agencies were using backchannel intimidation to blacklist entire legal industries they politically disagreed with, all without passing a single law or giving anyone their day in court. It was, they claimed, a way to regulate industries out of existence by denying them the basic ability to bank. The debate raged for years. Was Operation Choke Point a brilliant and necessary tool to protect vulnerable consumers from online predators? Or was it an unconstitutional overreach that threatened the rights of all legal businesses to participate in the economy? By 2017, under immense political pressure, the Department of Justice officially announced the end of the program. But its impact was permanent. The government had shown its hand. It had demonstrated that the most powerful form of regulation wasn't a law or a fine. It was control over the financial plumbing. And the private entities who owned that plumbing, the banks, Visa, MasterCard, were all watching. They had just been given a masterclass in how to wield power. They saw how the government could use access to their networks as a weapon. And a thought began to form. If the government can do this, why can't we? Why should we wait for a regulator to tell us who is too risky? We own the rails. We can make our own rules. The era of government action was about to give way to the era of private enforcement, a new form of regulation that would be faster, more opaque, and arguably far more powerful than anything Washington had ever conceived. This new power didn't reside in courtrooms or legislative chambers. It was hidden in plain sight in the terms of service we all agree to without reading, in the payment processing agreements businesses sign every day, and in the developer policies for the app stores that live on our phones. The new regulators weren't elected officials. They were payment networks like Visa and MasterCard. They were tech giants like Google and Apple. And they were the very banks that formed the circulatory system of the entire economy. Their weapon wasn't the law, it was access. The logic was brutally simple. If you can't process payments, you don't have a business. If you can't be found on a search engine or listed in an app store, you are invisible. These private companies controlled the essential infrastructure of the digital economy. And they were starting to realize they could set their own tolls, their own rules of the road for anyone who wanted to use it. The blueprint for this new form of control was, ironically, drawn up by the government itself. In 2013, the Department of Justice launched a quiet initiative that would become known as Operation Choke Point. The official goal was to combat mass-market consumer fraud by targeting banks that did business with fraudulent merchants. The DOJ argued that certain industries like payday lending, firearms sales, and other high-risk ventures were rife with illegal activity. Instead of going after thousands of small-time offenders, which was like a game of whack-a-mole, they decided to go for the jugular, the financial institutions that processed their transactions. The strategy was to put pressure on the banks. Federal regulators would send letters, increase scrutiny during audits, and suggest that servicing these high-risk industries could expose the bank to significant legal and reputational damage. The message, though never explicitly stated, was clear. Cut these clients loose or face the consequences. It wasn't a law. It wasn't a direct order. It was a powerful, calculated suggestion from an entity that could make a bank's life very, very difficult. And it worked. Terrified of regulatory blowback, banks began terminating relationships with entire categories of businesses, often with little notice or explanation. Entire industries suddenly found themselves unbanked, unable to get a simple checking account or process a credit card payment. Operation Choke Point was fiercely controversial. Critics from across the political spectrum blasted it as a gross overreach of executive power, arguing that it allowed government agencies to effectively shut down legal industries they simply didn't like, all without passing a single law or getting a single court order. It was regulation by intimidation. By 2017, facing intense political pressure, the Department of Justice officially announced the end of the program. On the surface, it looked like a victory for the industries that had been targeted. But the real story was that the lesson had already been learned. The government had shown the private sector a playbook, and the private sector was about to run with it, far beyond what the DOJ had ever imagined. The genie was out of the bottle. The banks, the payment processors, and the tech giants had seen firsthand how effective it was to regulate by controlling access. And they realized they didn't need the government's encouragement to do it themselves. In fact, it was better for them if they did. It reduced their own risk, it polished their public image, and it gave them immense, unchecked power over the digital marketplace. And so, the era of private enforcement began in earnest. In 2016, Google updated its Play Store policy to ban any app that offered loans with an annual percentage rate, or APR, of 36% or higher. Just like that, with a quiet update to a developer agreement, thousands of short-term loan apps vanished from the world's largest mobile ecosystem. There was no congressional debate. There was no public comment period. A handful of executives in Mountain View, California, made a decision that had more immediate impact on the online lending industry then years of legislative wrangling in Washington, D.C. Apple soon followed with similar restrictions on its App Store. Then came the payment networks. Visa and MasterCard developed their own sophisticated high-risk merchant programs. They used complex algorithms and internal risk assessments to identify businesses they deemed problematic. If a lender was flagged, they could face higher processing fees, be placed in a monitoring program, or have their ability to accept credit and debit cards terminated entirely. This was a corporate death sentence, and it was all happening in a black box. The criteria for being labeled high risk were proprietary and confidential. The decision-making process was opaque. A business owner could wake up one morning to an email saying their account was terminated, with no clear reason why and no effective path to appeal. They hadn't broken a law. They hadn't been sued. They had simply violated a private company's internal, ever-changing acceptable use policy. This new regime of private regulation had some undeniable upsides. It was incredibly fast. A policy change at Google could take effect globally in a matter of hours. This agility allowed these companies to respond to new types of predatory behavior or emerging scams far quicker than any government agency ever could. For consumers, this could mean real immediate protection from the worst actors in the online lending space. If a particularly nasty app was using deceptive practices, it could be vaporized from the App Store before it claimed too many victims. It was a level of responsiveness that the slow, deliberate pace of government rulemaking could never match. Proponents argued this was simply the free market at work, private companies choosing who they want to do business with, creating a safer environment for their customers in the process. But the downsides were profound and deeply unsettling. This new system lacked the two fundamental pillars of democratic governance: transparency and accountability. Who wrote these rules? A team of corporate lawyers and policy wonks, accountable only to their shareholders. What was the process for changing them? A series of internal meetings. If you were a legitimate, state-licensed lender who happened to fall just outside the arbitrary lines drawn by one of these tech giants, you had no recourse. There was no judge to hear your case, no jury of your peers. You couldn't sue Google for violating your due process rights, because as a private company, it didn't owe you any. This created a bizarre and confusing landscape. A loan could be perfectly legal under both federal and state law, but completely illegal according to Apple's terms of service. A lender could have all the right licenses from the government, but be blacklisted by Visa, effectively putting them out of business. The ultimate authority was no longer the state, it was a corporation. Power had shifted from the public square to the private boardroom. They had built a faster, more efficient system for stamping out bad actors. But in the process, they had also created a rulebook with no author, a courtroom with no judge, and a sentence with no appeal. And the first major test of this new system would come from an unexpected place, not from a shady lender, but from the very consumers they claimed to be protecting. This new battleground wasn't a corporate boardroom or a legislative chamber. It was a kitchen table in Ohio, a laptop screen in Florida, a smartphone in California. The challenge came from people like Brenda, a schoolteacher from Pennsylvania who needed $500 to fix her car so she could get to work. She went online, found a lender that promised fast, easy cash, and clicked, "I agree." She didn't read the 20 pages of fine print. Who does? She just needed to get her transmission fixed. The loan worked. The car was repaired. But then the payments started. Or rather, they never seemed to stop. Brenda thought she was paying down the $500. But after 3 months of payments, she checked her balance. She still owed $500. In fact, after fees and interest, she owed slightly more. She had fallen into what consumer advocates call the debt trap. The payments she was making were only covering the interest on the loan, an astronomical interest rate that was perfectly legal according to the loan agreement she'd signed. An agreement that stated any disputes would be governed not by the laws of Pennsylvania, where she lived and worked, but by the laws of a small Caribbean island nation. Pennsylvania had strict laws called usury laws that capped interest rates to protect consumers like Brenda. But this online lender, a company with no physical office in her state, claimed those laws didn't apply to them. They existed in the ether, in the borderless world of the internet. Brenda was just one. Soon there were thousands, tens of thousands, people from all walks of life, united by a single crushing experience. They began finding each other in the dark corners of the internet, on message boards, in consumer complaint forums. They shared stories that were eerily similar. A small loan to cover a medical bill that ballooned into thousands. Aggressive, relentless collection calls at all hours. Threats of lawsuits and wage garnishment. They were isolated, ashamed, and felt powerless. They had clicked, "I agree." Wasn't this their fault? But among the whispers of despair, a new sound began to emerge: defiance. A handful of consumer protection lawyers started noticing the pattern. They saw not just a series of individual bad deals, but a systematic, calculated strategy to exploit legal loopholes that had never been designed for the digital age. One of those lawyers, a man named Scott, started connecting the dots. He spent his days sifting through online complaints, piecing together the corporate structures of these lenders. They were like Russian nesting dolls, shell companies within shell companies, often registered in states with lax regulations like Delaware or Nevada, with payment processing handled offshore and customer service routed through call centers in yet other countries. The entire operation was a ghost, designed to be untouchable. Scott knew a single lawsuit wouldn't be enough. He needed to make a statement. He needed to challenge the very foundation of the lender's argument, that state laws stop at the state line. He found Brenda, and he found hundreds of others just like her in Pennsylvania. Together, they filed a class action lawsuit. It wasn't just against the lender. It was against the idea that a company could do business in a state while ignoring its laws. The lender's response was swift and confident. Their lawyers filed a motion to dismiss the case immediately. Their argument was simple and, on its face, powerful. The contract, they said, is king. Brenda clicked, "I agree." The contract she agreed to contained what's known as a choice of law provision. It explicitly stated that the laws of the Caribbean nation would apply. It also had a forum selection clause, which said any lawsuit had to be filed in that nation's courts. The lender's lawyers argued that a Pennsylvania court had no jurisdiction. The case, they insisted, didn't belong here. It was a private matter, governed by a private contract between their client and the borrower. This was the moment of truth. This wasn't just about Brenda's $500 anymore. The case, now being watched by regulators, consumer groups, and the entire lending industry, posed a fundamental question. Can a company use a digital contract to effectively create its own private legal system, exempt from the laws of the places where it operates and its customers live? Is a click-wrap agreement on a website powerful enough to nullify a century of American consumer protection law? The courtroom was quiet as Scott stood up to make his argument. He didn't focus on the complexities of contract law. He told a story. He talked about the purpose of usury laws in the first place, to protect the vulnerable from the powerful, to prevent exploitation. He argued that these laws represent the fundamental public policy of the state of Pennsylvania. To allow a company to simply write them away with a line of code and a hyperlink would make a mockery of state sovereignty. He painted a picture of a digital Wild West where the most predatory practices would be unstoppable, where companies could hide behind a labyrinth of international shell corporations while reaching directly into the bank accounts of American citizens. He argued that the lender's entire business model was predicated on this legal fiction. They advertised in Pennsylvania. They deposited money into Pennsylvania bank accounts. They withdrew money from Pennsylvania bank accounts. The only thing that wasn't in Pennsylvania was their willingness to follow its laws. The choice of a Caribbean island wasn't a matter of convenience. It was a deliberate strategy to evade regulation. The judge, a woman who had presided over contract disputes for 2 decades, listened intently. The old rules were clear. If two large, sophisticated corporations negotiated a complex international trade deal, they could absolutely agree to have disputes settled in London under British law. But was a schoolteacher in desperate need of a car repair the same as a multinational corporation? Was a non-negotiable, take-it-or-leave-it online form the same as a carefully negotiated contract? This was the friction point, the collision between the 18th century principles of contract law and the 21st century reality of e-commerce. The lender's argument was legally tidy. The contract is the contract. Brenda agreed. End of story. Scott's argument was about fairness, public policy, and the very nature of legal jurisdiction in a world without borders. The judge took weeks to decide. During that time, the online lending world held its breath. If the judge sided with the lender, it would be a green light. It would validate the offshore, choice of law model and essentially neuter the power of individual states to regulate online loans. The floodgates would open. But if she sided with the consumers, it would send a shockwave through the industry. It would mean that no matter how clever your corporate structure, no matter where you registered your domain name, if you loaned money to someone in Pennsylvania, you had to play by Pennsylvania's rules. The ruling came down on a Tuesday afternoon, not in a dramatic courtroom scene, but but as a quiet PDF file uploaded to the court's electronic docket. Scott opened the document, his heart pounding. The first few pages were a dry recitation of the facts. Then he got to the analysis. The judge wrote that while parties are generally free to choose the law that governs their contract, that freedom is not absolute. It cannot be used to circumvent the fundamental public policy of a state, and protecting citizens from predatory, high-interest loans, she wrote, was a fundamental public policy of the Commonwealth of Pennsylvania. She denied the lender's motion to dismiss. The case would move forward. In Pennsylvania, it was a monumental victory. A single line had been drawn in the digital sand. For the first time, a court had officially declared that state borders still mattered online. But the celebration was short-lived. The lender, backed by a billion-dollar industry, wasn't just going to give up. They immediately filed an appeal. And as they prepared for the next stage of the fight, they began to deploy an even more powerful, more constitutionally complex, and more controversial legal shield. One that didn't involve offshore accounts or Caribbean islands, but reached deep into the heart of American history and the very definition of sovereignty itself. The battle was far from over. It was about to get much more complicated. The shield they found was forged not in modern code, but in centuries of American law, treaties, and tragic history. It was called tribal sovereign immunity. This is a legal doctrine, deeply rooted in the U.S. Constitution, that recognizes Native American tribes as distinct, independent nations. Just like you can't typically sue the state of California in a Texas court, the principle holds that you can't sue a sovereign tribal nation in a state court without its consent. They possess their own governments, their own laws, and their own courts. For generations, this sovereignty was a means of preserving culture and self-governance. But in the digital age, a new generation of online lenders saw it as something else entirely. A loophole. A legal fortress that could potentially make them untouchable. Thus began the era of what critics would call rent-a-tribe lending. The model on its face was deceptively simple. An online lending company, often based in a place like Kansas or Tennessee, would partner with a federally recognized Native American tribe, often a small one with limited economic resources located in a remote area of Oklahoma or South Dakota. The lending company would provide all the infrastructure, the capital, the marketing, the call centers, the underwriting software, everything. The tribe, in exchange for a small percentage of the revenue, typically just 1 to 2%, would lend its name and, most importantly, its sovereign legal status to the operation. The loan agreements sent to borrowers across the country were masterpieces of legal maneuvering. They would explicitly state that the loan was being made by an entity wholly owned and operated by the tribe, that it was governed exclusively by the laws of that tribal nation, and that any disputes had to be resolved not in the borrower's local court, but through arbitration on tribal land. Suddenly, a borrower in New York, where the interest rate cap was 25%, was technically taking out a loan in a sovereign nation that had no such cap. When the New York Attorney General came calling, the lender would hold up the shield of tribal immunity and claim the state had no jurisdiction. It was a brilliant, and to many a deeply cynical exploitation of a law meant to protect a vulnerable population. One of the most prominent figures to pioneer this model was a man named Scott Tucker. A former professional race car driver, Tucker operated a massive payday lending enterprise from an office building in Overland Park, Kansas. But the loans, which carried interest rates that could soar past 700%, were officially issued by entities owned by the Miami Tribe of Oklahoma and the Santee Sioux Nation of Nebraska. Tucker's companies, like AMG Services, generated billions of dollars in revenue. He lived a life of extreme luxury with private jets, a fleet of race cars, and an $80 million mansion in Aspen. Meanwhile, the tribes he partnered with received only a tiny fraction of the profits, while his company allegedly preyed on millions of financially distressed Americans. He was the poster child for the rent-a-tribe model, and his success inspired dozens of others to follow the same playbook. For a time, it seemed like an unbreakable defense. State regulators were frustrated. They'd send cease and desist letters, and in response, they'd get a letter from a tribal lawyer asserting sovereign immunity. They'd file lawsuits, only to have them dismissed by judges who felt their hands were tied by federal precedent on tribal sovereignty. It felt like a game of legal whack-a-mole where the mallet was useless. The lenders were operating with impunity, openly violating state laws from behind a legal wall that states themselves couldn't seem to breach. But states didn't give up. Attorneys general and financial regulators began to collaborate, sharing strategies and legal theories. They started to argue that these weren't truly tribal businesses. They were elaborate shams. They developed a powerful legal argument known as the true lender, or real lender doctrine. The core of this argument was a simple question: who is really the lender here? To answer it, you have to look past the paperwork and follow the money. Who puts up the capital for the loans? Who bears the financial risk if the borrower defaults? And most importantly, who reaps the overwhelming majority of the economic benefits? In case after case, states argued that the answer wasn't the tribe. The tribe wasn't risking its own money. The tribe wasn't collecting 99% of the profits. The tribe was, in effect, a pass-through, a shell company renting out its legal status. The true lender, they argued, was the non-tribal company in Kansas or Florida, the one that controlled the entire operation from top to bottom. And if that company was the true lender, then it was subject to the laws of the state where it was doing business and where its customers lived. This argument began to gain traction in courtrooms across the country. Judges started to look more critically at the structure of these partnerships. They began to pierce the veil of sovereign immunity, scrutinizing the contracts between lenders and tribes. They examined who held the bank accounts, who hired the employees, who made the underwriting decisions. In one landmark case, a court famously described the tribe's involvement as nothing more than a fig leaf for a scheme to charge illegal interest rates. The legal shield was starting to crack. The battle was no longer just about jurisdiction. It was about the fundamental substance of the business arrangement. Lenders would argue that the tribe's involvement was substantial, that they were creating jobs and economic development for the tribe, and that states were infringing on their sovereign right to conduct commerce. States would counter-argue that a 1% revenue share wasn't economic development. It was a fee paid to evade the law. The legal fight became a war of attrition, fought in dozens of state and federal courts, with different judges reaching different conclusions. The landscape was a confusing patchwork of conflicting rulings. In some states, the tribal model held up. In others, it was struck down. But as the legal battles raged at the state level, two giants in Washington, D.C. were beginning to stir. The Federal Trade Commission, or FTC, had been watching this space for years, and it had broad authority to police unfair and deceptive business practices nationwide. And then came the creation of a new, powerful federal agency in the wake of the 2008 financial crisis: the Consumer Financial Protection Bureau, the CFPB. Unlike state regulators, the CFPB was armed with a federal mandate to protect consumers in the financial marketplace, and its authority wasn't necessarily stopped by state or even tribal borders. The federal government, with its vast resources and nationwide jurisdiction, represented a completely different kind of threat. Scott Tucker and others like him had successfully outmaneuvered individual states for years, but now they were about to face an adversary that couldn't be so easily dismissed. The FTC and the CFPB weren't just going to argue about who the true lender was. They were preparing to argue that these operations, regardless of their legal structure, were engaged in practices that violated federal law. The fight was about to escalate from a series of state-level skirmishes into a full-blown federal war. And the opening shots would change the entire industry forever. The year is 2010. The dust from the greatest financial crisis since the Great Depression is still settling. Out of the wreckage of Wall Street bailouts and Main Street foreclosures, a new federal agency is born. It was forged in the fires of public outrage and given a name that was both a mission statement and a warning: the Consumer Financial Protection Bureau, or CFPB. This wasn't just another three-letter agency destined to be buried in the Washington, D.C. bureaucracy. This was different. The CFPB was designed from the ground up to be a new kind of regulator, a financial supercop with a single laser-focused mandate: to protect American consumers in the financial marketplace. For the online lending industry, which had thrived in the gray areas between state laws, the creation of the CFPB was the equivalent of a massive storm system forming just over the horizon. The Bureau was armed with a powerful three-pronged spear of authority. First was rulemaking. The CFPB could write new, nationwide rules for financial products, setting a federal floor of protection that had never existed before. No longer could a lender simply hop across a state line to find a more favorable regulatory environment. Second was supervision. For the first time, a federal agency had the power to directly examine the books of non-bank financial institutions, including large online lenders. They could walk in the door, or in this case the digital door, and demand to see everything. The days of operating in the shadows were numbered. And third, the most feared prong of the spear: enforcement. The The CFPB was given the authority to sue companies for breaking consumer financial laws and to levy massive fines. This was the power that would be used to fire the opening shots in this new federal war. The Bureau didn't waste time. It began scanning the horizon for targets, looking for the business models that caused the most consumer harm. And its eyes quickly fell upon the most controversial and legally ambiguous sector of the online lending world, the tribal lending model. The CFPB decided to make an example, and it chose a case that would become a landmark battle: CFPB versus Cash Call. This wasn't just a lawsuit, it was a showdown. On one side you had Cash Call, a massive non-bank lender based in California, and its partner Western Sky Financial, an entity chartered under the laws of the Cheyenne River Sioux tribe. Together, they originated thousands of high-interest loans online to consumers across the country, many in states where those interest rates were illegal. Their defense was the one that had worked for years. Western Sky, as an arm of a sovereign tribe, was immune from state law and state interest rate caps. And since Cash Call was merely servicing the loans that Western Sky originated, it too was protected. It was the classic rent-a-tribe playbook. On the other side, you had the brand-new CFPB, eager to prove its power. The Bureau's argument was devastatingly simple and cut right through the complex legal structure. They argued that the entire tribal arrangement was a sham. They presented evidence showing that Western Sky had almost no employees and performed minimal work on the loans. The underwriting, the marketing, the funding, the collecting, nearly every meaningful aspect of the lending business was handled by Cash Call in its California offices. The CFPB's lawyers painted a picture not of a legitimate tribal business, but of a California lender using a tribal entity as a legal shield to ignore state laws. They invoked a legal concept known as the true lender doctrine. The question they posed to the court was simple: who is the real lender here? Who is putting up the money and bearing the risk? But the CFPB had another, even more powerful weapon in its arsenal. It argued that even if the court decided the tribe was the true lender, it didn't matter. Why? Because while tribes may have immunity from state laws, they do not have immunity from federal law. And the CFPB wasn't suing them for violating New York's or Colorado's interest rate caps. It was suing them for violating the Consumer Financial Protection Act itself, specifically for engaging in unfair, deceptive, or abusive acts or practices. The infamous UDAP. UDAP was the CFPB's nuclear option. It's a broad, powerful standard that allows the agency to go after conduct that might not fit into a neat, predefined box of illegality. An act is unfair if it causes substantial injury to consumers that they cannot reasonably avoid. The CFPB argued that issuing loans with interest rates of 90 to 340%, knowing consumers would be trapped in a cycle of debt, caused exactly that kind of substantial, unavoidable injury. An act is deceptive if it misleads a consumer, and an act is abusive if it takes unreasonable advantage of a consumer's lack of understanding. The CFPB alleged that the complex loan agreements and the very nature of the lending model were designed to do just that. The court battle was intense. The entire online lending industry watched, holding its breath. The outcome would determine the future of the high-cost, short-term loan market in the United States. Finally, the decision came down. The federal judge sided with the CFPB on almost every point. The court ruled that, based on the totality of the circumstances, Cash Call, not the tribal entity, was the true lender. The money, the risk, and the profits all flowed from the California-based company. The court effectively declared that the emperor had no clothes. The tribal sovereignty argument in this case was a hollow facade. This ruling alone was an earthquake. It meant that the loans were subject to the state laws where the borrowers lived, making thousands of them legally void or uncollectible. But the court went even further. It affirmed the CFPB's power to enforce federal law, including UDAP, against online lenders regardless of their affiliation. The message was clear and unambiguous. Tribal immunity is not a get-out-of-jail-free card to escape federal consumer protection laws. The fallout was immediate and catastrophic for the defendants. Cash Call was ultimately ordered to pay hundreds of millions of dollars in refunds and penalties. The case effectively dismantled one of the largest online lending operations in the country and sent a shockwave of terror through every other company using a similar rent-a-tribe model. Their legal shield had been shattered. The federal government had proven it could reach across state lines, pierce the veil of sovereign immunity, and hold them accountable. The Cash Call case was more than just one enforcement action. It was a statement of intent. The CFPB established a powerful precedent. It showed the industry that the old playbook was obsolete. Finding loopholes in state laws was no longer enough. Now lenders had to contend with a powerful federal watchdog, armed with broad authority to police the entire market for unfair and abusive practices. This forced a dramatic shift in the industry. Many players in the high-cost space simply went out of business. Others scrambled to restructure their operations, desperately searching for a new model that could withstand federal scrutiny. The era of the Wild West was officially coming to an end, but the industry is nothing if not adaptable. As the rent-a-tribe model crumbled, a new, more sophisticated legal strategy was already taking its place, one that would partner not with tribes, but with established, federally regulated institutions. This new model would pose an even greater challenge to regulators, blurring the lines between predatory lending and mainstream banking, and setting the stage for the next great regulatory war. This new battlefield wasn't a shadowy corner of the internet anymore. It was brightly lit, powered by venture capital, and fronted by slick, user-friendly apps. The combatants were no longer just payday lenders versus state attorneys general. The new players were fintech, financial technology companies that promised to democratize finance, to use algorithms and data to offer credit to people the big banks had left behind. And their key strategy, their Trojan horse into the heart of the American financial system, was a controversial model that came to be known as the rent-a-bank scheme. The concept is both genius and, to its critics, deeply insidious. A fintech company is not a bank. It doesn't have a bank charter. This means it's generally not subject to the heavy, expensive, and restrictive federal banking regulations. Instead, it's primarily regulated at the state level, just like the old payday lenders. And as we've seen, that means it would be subject to each state's individual interest rate caps. A fintech in New York couldn't offer a 100% APR loan to a New Yorker. But what if the loan didn't technically come from the fintech company? What if the fintech firm was just the middleman, the storefront? Here's how it works. The fintech company partners with a relatively small, often obscure state charter bank that is federally insured by the FDIC. This bank might be located in a state with very weak or non-existent usury laws, like Utah, Delaware, or South Dakota. When you, the customer, go to the Fintech's app and apply for a loan, you're interacting entirely with the Fintech's brand, their technology, their customer service. Their algorithm decides if you're approved and at what rate. But at the moment the loan is officially created, the legal documents say the lender of record is that partner bank in, say, Utah. A few days later, the fintech company often buys the loan back from the bank, taking it onto its own books. Why go through this elaborate dance? Because of a landmark 1978 Supreme Court decision, Marquette National Bank v. First of Omaha Service Corp. Star. That case established a critical principle. A national bank is allowed to export the interest rate of its home state to borrowers in any other state, regardless of the borrower's state laws. So that bank in Utah, which has no interest rate cap, can legally issue a 150% APR loan to a borrower in Colorado, where the state cap is 36%. And because the fintech is just servicing a loan made by the bank, it claims it can operate under the bank's legal umbrella, effectively ignoring Colorado's state law. To state regulators and consumer advocates, this was a declaration of war. They saw it as a blatant and cynical circumvention of laws that were put in place to protect vulnerable consumers from predatory debt traps. They argued that the bank was a bank in name only. It wasn't taking any real risk. It was just renting out its charter, its legal privilege, for a fee. The real lender, the entity with the predominant economic interest, the one making all the key decisions, was the fintech company. This argument gave rise to the true lender doctrine. State regulators, led by attorneys general in states like Colorado, New York, and California, began suing these partnerships. Their legal argument was simple. Look past the paperwork. Look at the substance of the transaction. Who markets the loan? Who underwrites it? Who funds it and takes on the risk? If the answer to those questions is the non-bank fintech, then the fintech is the true lender, and it must therefore comply with the state's interest rate caps. For a while, this strategy saw some success. Courts in some jurisdictions were sympathetic to the true lender argument, sending a chill through the fintech industry. The battle lines were drawn. On one side, you had state regulators and consumer groups trying to uphold state-level protections. On the other, you had the fintech industry and their bank partners, arguing they were promoting financial innovation and inclusion, and that a patchwork of state laws was stifling progress. Then the federal government picked a side. The Office of the Comptroller of the Currency, or OCC, is the primary federal regulator for national banks. Under the Trump administration, the OCC issued two crucial rules that were a direct counterattack against the true lender doctrine. The first rule basically said that if a national bank is named as the lender on the loan documents, then it is the lender, full stop. It explicitly rejected the idea that courts should look deeper to find a true lender. This was a massive gift to the rent-a-bank model, providing a legal shield against state lawsuits. The second and even more powerful rule was the valid when made rule. This rule established a simple principle. If a loan is legally valid and not usurious at the moment it is created by a bank, it remains valid for its entire life, even if it's sold to a non-bank entity. This was designed to kill the argument that once a fintech bought the loan back from the bank, it became subject to state usury laws. The OCC argued that without this rule, the secondary market for loans, a critical part of our financial plumbing, would be thrown into chaos. The effect was immediate and profound. It was a federal green light for high-cost lenders to partner with banks and operate nationwide, bypassing state consumer protection laws. Consumer groups were apoplectic, calling it the rent-a-predator rule. They argued the OCC was actively helping predatory lenders evade the very laws designed to stop them. The fight escalated, moving from the courts to the halls of Congress. In a rare and dramatic move, Democrats in Congress utilized the Congressional Review Act, a legislative tool that allows lawmakers to overturn recent federal agency regulations with a simple majority vote. In 2021, with a new administration in the White House, Congress successfully voted to repeal the OCC's true lender rule. It was a stunning rebuke of a federal regulator and a major victory for states' rights and consumer advocates. The valid when made rule, however, remained in place, leaving the legal landscape murky and confused. Meanwhile, another powerful federal player was making its moves. The Consumer Financial Protection Bureau, the CFPB. The CFPB's authority and aggression has waxed and waned depending on the presidential administration, but its focus has often been on the substance of financial products, not just the legal loopholes. The Bureau began to scrutinize these fintech bank partnerships, not just for usury, but for unfair, deceptive, or abusive acts or practices, known as UDAP violations. The CFPB's angle was different. They might not be able to enforce a state's 36% interest rate cap directly, but they could sue a company for deceptive marketing. For example, if a fintech's app made it incredibly difficult for a borrower to understand the true cost of the loan, or if its repayment structure was designed to be confusing and trigger fees, the CFPB could step in. They started to look at the whole customer experience. Was the advertising misleading? Were the terms and conditions clear? Was the company being honest about the consequences of default? This created a multi-front war. State attorneys general were still fighting the true lender battle in court, with mixed results. Congress was playing regulatory whack-a-mole, striking down rules they disliked, and the CFPB was using its broad UDAP authority to police the behavior of the lenders, regardless of the interest rates they charged. The result is a state of profound uncertainty. For a fintech lender, the legality of its entire business model might depend on which federal circuit court it's in, who is currently in the White House, and which party controls Congress. This regulatory chaos has done little to solve the core issue. On one hand, millions of Americans remain underserved by traditional banks, and technology offers a potential pathway to access credit. On the other, that same technology, when paired with legal loopholes, can be used to deliver incredibly high-cost, potentially destructive loans at a scale and speed the old storefront lenders could only have dreamed of. The regulatory framework, built over a century of state-by-state battles and federal interventions, was simply not designed for a world where a bank in Utah could partner with a software company in Silicon Valley to issue a loan in seconds to a borrower in Maine, completely bypassing Maine's laws. The system is cracking under the strain, torn between the foundational American principles of states' rights and the borderless nature of the new digital economy. And as artificial intelligence and even more sophisticated algorithms begin to enter the underwriting process, the question of who is truly making the lending decision and who should be held accountable is becoming almost philosophically complex, pushing our analog-era laws to the breaking point. This very breaking point is forcing us to confront a new kind of intelligence, one that operates inside what engineers call a black box. An AI model can analyze millions of data points, far more than any human underwriter, to make a lending decision. It might find a correlation between, say, the time of day you apply for a loan and your likelihood of default. But if you ask it why that correlation exists, the AI can't tell you. Even its creators might not know. So, If that algorithm denies you a loan, or charges you a higher interest rate based on a pattern that is secretly a proxy for your race, or your zip code, or your medical history, how do you prove it? How does a regulator prove it? The machine's logic is inscrutable. This isn't just a technical problem. It's a legal and ethical minefield. The Equal Credit Opportunity Act was written with human bias in mind. It was designed to prevent a loan officer from making a decision based on prejudice. But how do you regulate a prejudice that has no conscious thought behind it? A bias that is simply a cold statistical inference buried in a trillion calculations. This challenge is so profound that it's sparking a revolution not just in lending, but in regulation itself. Welcome to the world of RegTech, or regulatory technology. If financial companies are using sophisticated technology to issue loans, government agencies are now exploring using that same level of technology to police them. Imagine the Consumer Financial Protection Bureau deploying its own AI, an algorithm designed to audit the lender's algorithms. This regulatory AI could submit millions of ghost loan applications, synthetic profiles of different races, genders, and backgrounds, to a lender's online portal, just to see if the system produces discriminatory results. It could analyze nationwide lending data in real time, searching for statistical red flags that would be invisible to a team of human auditors. It's a technological arms race, a battle of algorithms where regulators are trying to build a smarter watchdog to catch a smarter fox. The future of consumer protection may not be an investigator with a clipboard, but a piece of code designed to ensure fairness. But just as regulators are beginning to wrap their heads around AI, a new frontier is opening up that makes algorithm-based lending look simple by comparison. Decentralized finance, or DeFi. DeFi aims to rebuild the entire financial system on blockchain technology, without banks, without loan officers, without corporations. Lending platforms can exist as smart contracts, self-executing agreements written in code that live on a global network. You can borrow cryptocurrency from a pool of assets supplied by other anonymous users, with the terms of the loan enforced automatically by the contract. There is no central company to sue. There is no CEO to subpoena. There's no headquarters to send a cease and desist letter to. This poses an existential question for the entire framework of U.S. regulation. The system we've discussed, this patchwork of federal and state laws, is built on the idea that a lender is a tangible entity that exists in a specific place. It has a state charter or a federal license. It operates within a jurisdiction. DeFi obliterates this concept. Who is the lender when the loan is issued by a decentralized autonomous organization, or DAO, whose members are anonymous token holders scattered across the globe, voting on protocol changes from their keyboards? If a U.S. citizen gets an unfair loan from a DeFi platform whose code was written by a developer in Estonia, and whose liquidity was provided by users in Japan and Brazil, which law applies? The Truth in Lending Act? New York's usury laws? It's a jurisdictional nightmare that current laws are completely unequipped to handle. Regulators like the SEC and the Treasury are grappling with this right now, trying to figure out how you can possibly apply century-old legal principles to a borderless, leaderless, and code-based financial system. And underlying all of this, the AI, the RegTech, the DeFi, is the single most valuable commodity of the 21st century: your data. Historically, your creditworthiness was defined by a very narrow set of data points: your payment history, your debt levels, your FICO score. But in the age of big data, that's changing. Lenders are increasingly exploring the use of alternative data. This can include everything from your utility and rent payments, which can help people with thin credit files, to far more invasive metrics. Think about your online behavior, your social media connections, the apps on your phone, even how you type and scroll on a web page. To a data scientist, all of this is a potential signal. It's a clue about your stability, your reliability, your character. This blurs the line between financial regulation and data privacy. The fight to control how your financial data is used is now part of the larger fight for control over your entire digital identity. Laws like the California Consumer Privacy Act, CCPA, give you rights over how companies collect and use your personal information. These laws are now on a collision course with the financial industry's insatiable appetite for data. A future loan denial might not come with a clear reason related to your credit report. It might be the result of 1,000 tiny data points about your life that you unknowingly gave away, all fed into an algorithm that made a judgment about you. So where does this leave you, the individual trying to navigate this incredibly complex and rapidly changing world? Can feel overwhelming, like you're up against forces far beyond your control. But the opposite is true. In this new landscape, knowledge is not just power. It is your primary shield. The most important thing you can do is become the regulator of your own financial life. This starts with understanding your fundamental rights. The laws we've talked about, the Truth in Lending Act, the Equal Credit Opportunity Act, the Fair Debt Collection Practices Act, are still your bedrock protections. Know what they entitle you to: clear disclosures, fair treatment regardless of your background, and freedom from harassment. Second, become a ferocious reader of the fine print. Before you click "I agree" on any online loan, read the terms of service and the privacy policy. What data are you giving them access to? How will it be used? Are you agreeing to mandatory arbitration, waiving your right to sue them in court? These are no longer just legal formalities. They are the rules of engagement in a digital world. And third, use the tools the system provides. The CFPB's Consumer Complaint Database is a powerful resource. By filing a complaint, you not only seek resolution for yourself, but you also provide regulators with the data they need to spot patterns of abuse. Check your credit reports regularly from all 3 bureaus. It's free, and it's your financial report card. Dispute any errors you find. Ultimately, the story of online loan regulation is a microcosm of a much larger struggle. It's the story of how we, as a society, adapt our old rules to new and powerful technologies. It's a constant tug-of-war between the promise of innovation, greater access to credit, more efficiency, lower costs, and the peril of exploitation, digital redlining, data abuse, and inescapable cycles of debt. The law is always a few steps behind the technology. The regulators will always be playing catch-up. What fills that gap is your awareness, your diligence, and your willingness to demand transparency and fairness. The digital frontier of lending will continue to expand in ways we can't yet imagine. And as it does, the most critical question we must continue to ask is not simply whether a new financial product is possible, but whether it is just.